Hello traders, welcome to FreeFX. Today is the 12th of April 2016. My name is Francesco Sani. This is a disclaimer, and today we're going to talk about correlation between currencies and other asset classes. So the topic of the day is correlations ? Now, in terms of this, so the next thing we're going to look at is correlations between currencies and other aspects, other sources, if you like. So we'd like to start with the British pound. On the right hand side here, I've got the British pound versus the US dollar. Now, I'd like to start the conversation with this because it's been on a lot of traders' minds on forums in terms of the how to find an edge with the British pound because it's so devalued at the moment. So the conversation with the British pound must begin in terms of its relative positioning. We know that if we look at the historic rates on fxtop.com, the historic chart here for the pound US dollar, you can see from the 1950s, I've basically given you about 50 years from 1966 to 2016. You can see how we are at the moment poised around this historic floor, going back all the way to the 90s and indeed up to the late 80s as well. So from about 1980, you can see that as being 1987 or 1986. So basically from for the last 30 years, we've been not anywhere near below the 140 floor. We sort of poked through it briefly recently, and back here in the great financial crisis of 2008, 2009, but we haven't actually gone below it with strength. So we never made it to 130, for example, like here in 1985. So this is a significant level, 140, because historically it's still holding. So looking at this chart, we must try to think where is this going next, and the big question is how to get an edge when trading the pound. So let's talk about correlations. The topic of today is trying to find ways to get an edge and find basically ways to, for me personally, I trade long term, so I do find it at the moment I'm about 7-8 months into this new strategy. So it's very difficult to say it's working, it's not working, because it's a holding game. So it's not very easy to show profits yet as the trades unfold. But basically my 3 trades are all pound centered, so I have an interest in a pound, so I thought I'd mention that because it kind of shapes the conversation a little bit. This particular idea of correlations with the pound is takes many forms. So for example, if you're trading long term, it's easier to see correlations than short term because in a very short term, correlations can switch apparently. But certainly I'm no expert, so please correct me or leave comments if you know otherwise. But I deal more with long term in terms of my interests, where I'm going with my trading. So from that point of view, if you're not interested, you might want to switch off now. But really, the point is that the long term shapes also the short term. So if you're trading, say, within a day, and you make small gains, this may not relate to you generally in your trading profit targets and stops, but if you are trading within a trend or trying to trade within a trend, you might still be interested in knowing where that trend is going. Now, the Daily Reckoning, which is a website that I was reading recently about their idea that this is a big head and shoulders pattern, and this would lead to a break below 140 all the way down to as far as it will go. Now, and the fact that it hasn't happened for the last 30 years doesn't mean to say that it couldn't happen. So the possibility for the pound dollar going down is there. Ideally, and say ideally because a lot of people are speculating about the pound from this floor going up, and this is something that a lot of people do. Trying to pick bottoms. I'm guilty of that as well. So it is quite easy and tempting to say if I catch it now, I go in long and ride it all the way up to 210. Well, that's great. So, it could happen, but we don't know for sure. So how do we know where this is going? Let's find correlations with other things. And one of the things I want to bring in is trying to get away from Forex, really, because Forex is Forex. So it's price fluctuations. We we sit and wait for price fluctuations, and charts don't really tell us anything, because this chart I'm showing you, I'm only really using it because it's such a long-term chart, just to show you the context of price. But it's not to say that 140 will hold forever. It's a strong level, you can't deny that. And the fact that you see it black and white, or in this case blue and white, on the chart line doesn't mean to say that we should ignore it, but it doesn't mean to say that it will hold. So who pushes price up? Not retail traders. So if you're looking for clues from the retail crowd, at the moment it might vary from different brokers. Some brokers crowds might be shorting the pound. Some of them might be heavy long, because they're expecting this to be a bottom and to go up. So from the Forex point of view, we don't have a centralized system for the spot Forex market, so difficult to see where the volume lies. But there are different ways we can look into that. Just coming away from Forex for a moment, I just wanted to show you that basically this is the Bank of England. This is from the website Trading Economics, and the Bank of England's rate. Okay. So if you look from the 70s, so I'm just going to making it available left and right. So left hand side now you got from the 70s the Bank of England rate, okay, which, as you know, has been flat for the last few years. And on the right hand side you've got the pound dollar, again from the 70s. Now you can kind of see from the curve, okay, that at the height here, the Bank of England rate was, if I can just get this a little bit bigger so you can see, Bank of England rate was, I think it was in the region of 16 or 17%. So, from that point of view, you can see how the high interest rate here was mirrored by the high value of the pound back here, okay, 1977. We're at levels of roughly 2.4, and we came back to it in 1981, 82, 2.4, 2.45, and we've not been back to there since. Now we know that inflation was rampant back then, and so the Bank of England was pushing the interest rate up to match the inflation, to try and minimize or downplay the effects, the noxious effects of inflation. Now, I'm not going to provide a history lesson here because it gets a little bit complicated and probably unnecessary. But just from a chart point of view, you can see that the correlation is strong between interest rate and the pound value. Now, with that in mind, the interest rate at the moment has been flat for quite a while. So you might ask, where are we going with this? Well, let me show another thing as well. And this is the other thing that we can use for more recent price history. And for that, really, I'd like to show you the LIBOR rate. This is the London interbank rate, offer rate, which is really just for banks. So what you want here is, apologies about the desktop image. What we want here is trying to gauge something more short term, or more recent if you like. So I'm going to go into the pound chart again. So this is basically the pound chart from the beginning of 2016, more or less. Okay, and you can see that the Bank of England rate has been flat, okay, at 0.5. And so there's no change, and yet you see movement in the pound dollar. Now look at this shape here, and look at the shape here of the look at the shape here of let's make it really precise. Now can you not see a similarity between these two curves? This is the LIBOR 12-month rate So this is the interbank. This is what the rate at which banks lend unsecured funds to each other. The London banks that are part of a panel, and they this rate is very much monitored, so they actually keep an eye on this rate. It's very transparent, and it's highly monitored because it gives an idea of what goes for a lot of assets like mortgages, pension funds, etc. So it is very important to keep an eye on it for that reason. Now, you can see how we are currently about the 1.0 mark, okay, and how it's been fluctuating. It's been sort of downgraded, and equally you can see that the pound dollar has fallen almost at the same pace. Okay, now this dip here was in February, and sure enough, in February we had a dip in the LIBOR rate, and the sort of drop down here is near equal to that, but not necessarily the same. So what I'm trying to say is that you can try to have a look at the LIBOR rate, and if we can change it to 6 months, for example, you can see the LIBOR rate here for 6 months, and then you can compare the chart of that to that of the pound, and you can see whether that more closely matches the movement of the pound. Okay. Now, obviously, it's not like for like, but you know, if you can see sort of in the longer term, this is going back to the 60s, etc. So we're going back to this chart here, and the longer term from the 60s, etc. is this, and this is the long-term interest rate development for through LIBOR. Okay, so that's where we are now. Okay, so the movement is quite a lot more flat from the great financial crisis 2009 onwards, so fluctuating between 0 and 2 essentially, whereas the pound has been fluctuating much more, really between these rates, 140 to 170. Okay, 140 to 170. That's 3,000 pips in forex points. But keeping an eye on the LIBOR rate might, because it's updated daily, the overnight rate is updated daily, you might see changes. This might give you a direction of perhaps confidence, sentiment, who knows. So that's one thing that you can use for correlation. The other thing that you can use for correlation is the one that I've mentioned before in one of my videos, and this is the Gilts. So you can see on this chart, and this is from ukinvesting.com, you can see from this chart that the correlation in between the two assets is inverse, and it's very strong, and you can verify this on Oanda's correlation table. So you can see on oanda.com the heat map, if you select the 10-year gilts, gives you against the British pound US dollar. Okay, 1 day is moderate negative, so moderate inverse correlation. 1 week, very strong, nearly 1, 0.94. 6 months, again, quite strong, and 1 year, quite strong as well. So basically on a weekly, 6 monthly, and yearly, there's a very strong correlation. So over time, okay. So obviously on the hour, monthly, maybe not so much. So going back to our investing.com chart, again, without over relying on chart, this doesn't tell us that the pound is going to rally. It doesn't tell us that the 10-year gilts, which are basically the UK bonds, equivalent of the Treasury bonds in the United States. These are the sort of safe assets guaranteed by government. You can see that it's expressed here in investing.com in percentage. We are sort of floating about this range, if you like, from 7.5 to 15%. And I put a box around it just to give us a rough idea of the supply zone. You could sort of narrow it down to maybe just between 10 and 15 as being the supply zone. So we may get to the bottom of this box, not necessarily below as low down here as the 2014 January low. But the fact that they are inversely correlated, you can see that if I change this to a line chart, there we go. You can see even better the inverse correlation between these two assets here, especially in 2013, 2014. The interest rate expectations for the pound as it rose all the way up to the 1.70, and the gilts dropped. Okay, so basically, then as they go up, the pound comes down. What is the point of this correlation? You might ask. I think it's hard to say where this is going again, but it's another tool that you can use to try to gauge where we are. If the gilts were to come down from these tops and really start gaining momentum, you should, given the correlation to the pound, for whatever reason, we're not going to go into whys and wherefores, but if this correlation holds, as it seems to be at the moment, then the two should go hand in hand. So as confirmation, if you started seeing the pound rising, with or without finding explanations for it, if you just wanted to trade it as an upswing or as a correction of this downtrend or as a start of a new uptrend, and you saw that the gilts were dropping inversely to the pound dollar, then that would be further confirmation because of this correlation that is a mirror version of each other. So okay, so for euro, basically I've taken the EURUSD and this is the FXCM market scope 2.0 trading, and this is the price basically from January, and this was the last rate decision from the European Central Bank, and you can see that I'm going to compare a couple of things in a second which you'll find interesting, I'm sure. And what I'm going to show you is comparing these two. So on the one side I have the EURUSD, and I've added an indicator at the bottom. This is the directional volume. So essentially this is the retail side on the left, and you can see that on the long candle here, which is the 10th of March rate decision, if I click on it, now below you can see quite clearly that the buyers in blue and the reds, the sellers, are not the same. So you can see clearly that there were more sellers than buyers on the day. If I click on that, you can see that there were 3 billion buying in terms of volume and minus 4,331,000,000 sellers. This is the Euro futures, so not Euro USD. Oh, the chart is Euro USD because it's basically the main exchange rate. The futures contracts for currency futures are based on the US dollar. But they are traded as the single currency that you trade. So this is the Euro futures, not Euro USD. So, but for Euro futures, on the day, the 10th of March, you can see that this big candle actually had a massive buying volume. Okay, so futures contracts bought for that day were overwhelmingly buy contracts. So it was a big buying volume. Now you can see that the buying volume has stayed strong. It was superseded by sell volume the day after, but open interest is a purple line, so it's remained constant, and you can see also the contrast between the futures and the currency futures and the retail. But this is obviously just one broker, FXCM's trading data, and it's a global large broker, so it does give an idea of sentiment within the trading community of retail traders, but they don't move the markets, we don't move the market, retail traders. So it is important to correlate this which is mostly selling, with the mostly buying of currency futures. And indeed, if you see, the result of that was the losers were the sellers, because on the day, in spite of the ECB and Draghi doing, as we know, it went pear-shaped, they did what they could to expand on QE, and there was a rally. So really, currency futures were on the right side of the market, you might say. The other thing we can use as well is one more. Now this, I could go more into this, but I don't want to spend ages. But the tool is there. Basically, if you go to bar chart, and if you put in E6, that's a Euro futures. Basically, currencies. E6 is just the initial, E for Euro, B for pounds. We put B6. This is the contracts expiring in 3 months, from March to June. There's also September contingent, but that's going into more detail than we have time for. This is the OANDA commitment of traders from the CFTC. CFTC is the Chicago Futures and what is it? Chicago Futures Trading Commission, I think, commitment of traders report. And this is the chart they've put up. Basically, it's converting all that data, which is numerical. And if you're not seeing it, I won't show you now, but it's basically just the numbers with the open interest, short, long contracts on currency futures, and it's divided into different sections. This here basically puts together all the non-commercials, and that's basically explains here what non-commercials are. Non-commercials are held by large speculators, mainly hedge funds and banks trading currency futures for speculation purposes. Okay, so the open interest is at the bottom, and here is in orange is the line for EURUSD, and the top bars here are showing you the positioning. And as you can see, for the last X number of months, going to basically a year, currency futures contracts have been short. Okay, so heavily short, a bit less, again heavily short, and a bit less. So it is getting lighter, and this is the last commitment of traders report from the 5th of April. So it was last Friday for the Tuesday. Sorry, last Friday was the 8th, and it relates back to the Tuesday, so the 5th of April. So on the 5th of April, according to the Chicago Board of Exchange, the currency futures that they hold, each contract is of 125,000 euros, and we have basically the open interest is 338,533 contracts. If you multiply that in money, it's a lot of money, and it's still negative by a bit, although it's been lightening. As you can see, it's a sort of a game of catch-22 between the speculators and the euro. Now, which moves which? Well, obviously, banks, commercial enterprises like banks, they have large pockets, so they move markets. But speculators also provide a lot of liquidity. Certainly, they move the markets to a lesser extent. But whether they follow or they push the market, personally, I don't know. I really don't know how to prove either way. But certainly, if you see the correlation here between what's happening with the euro futures, is that they are lightening on the shorts, and the euro has been rising. So basically, taking off short contracts means closing positions, closing contracts for shorts, and this allows the euro to breathe up. But we know that the boundary for the euro is the 115, because for the last 15 months the euro has entered this range with the bottom at 105 and the top at 115, and it's not really escaped that. So it's not really unthinkable that we're going to stay within that range. Now we have reached this sort of 115 level before, around here, 20th of October. So and what happened then was that the contract started going short, deeper short again, and the euro was pushed back down towards the bottom of that range, 105. So it's worth keeping an eye on this. It's a lagging indicator, but it's a centralized currency futures market sentiment indicator rather than your speculative retail side, which doesn't really move the markets, but and it can be on the wrong side, as I showed you before. So I think it's worth using all these tools to kind of gauge sentiment in ways that that you don't have. One thing that I should mention as well is the EURIBOR rate. And the EURIBOR rate, as you can see, comes in different shapes. This is www.euribor/rates.eu. So like the LIBOR rate, it's not a one rate, it's actually divided into different ones. There's all the way to the 12 months. So I've given you the 12 months here because it's sort of more long term. It's pretty sort of flatlined in the last month. If you look at sort of 12 months, can't really get the charts open, but it's this kind of small chart here. See if I can get it bigger. Okay, that's it. So 12 months has dropped from 0.2 to 0 negative. Okay, this is basically where we are with the EURIBOR, and this has dragged the euro pretty much down, or any prospect of the euro rising. So the fundamental influence of EURIBOR, not as direct as we've seen with the LIBOR and the pound dollar, because the fundamentals are bearish on the euro, and there is a speculative side of euro buying, which is fundamentally that. Okay, go back to the last 12 months. So from April of 2015. Get it on the screen. Okay, so that's basically from April 2015. So from April 2015, which is pretty much near the that's April there. So we're at the bottom of that 105 to 115 range, and then 115. So we've basically been ranging from April 2015 to now between 105 and 115, as I was saying before. But if you compare that to the EURIBOR rate for the last 12 months, you see that the euro has been sort of choppy and ranging, and the EURIBOR has been steadily dropping. So the correlation is a little bit different here, and what it shows that is for me at least, what it shows that if I were to use this as an edge to try and see where this is going next, we're going to negative territory. Does that mean that we're going to pick up? Well, if you look at the from 1999, you see that it sort of escalated in a great financial crisis, and it dropped, and it's dropped to a horrific low, compared to from 1999. That's a long time, and it's dropped to these historic lows. So is it going to drop further, or is it going to pick up? Well, it's really hard to predict, but going with sort of current sentiment, we're either going to flatline around 0 or drop further into negative rates, which is unprecedented, but it could actually drop to minus 0.1 or stay around just under 0 as we are at the moment. So fundamentally this tells us that the euro should be dropping, but speculatively speaking, the euro is doing this. Okay, and if we went back to the euro side, we could see that as we've seen before, we'd have to see what the COT report has to say. So the COT report is that the shorts are lightening, but they're not giving up. So this could pick up again more shorts as we're coming up to this sort of top of 115. So we have a sort of approximate target 115 from which more shorts might come in. We have a fundamentally weak euro and EURIBOR. So the edge here would be that we are waiting for confirmation and going short. We can play a range of 115 to 105, which is about 1,000 pips. A portion of that, if you can get even 50% of that, will be 500 pips. If you're trading long term, if you're trading short term, again, you can sell EURUSD on the shorter term. This will affect other currencies as well, like Euro GBP. So then you can play the currency correlation between different currency pairs. But I just today wanted to show you that it's not just about playing correlation between different currency pairs. So here, for example, is correlation between EURUSD and Euro Pound, and they are kind of quite strongly correlated at the moment. So the Euro rising has pushed the Euro Pound up. But this could change if the pound gets more momentum, but we don't know about that. So again, if you're not getting much in terms of where this is going, because if the euro is rising and euro pound is rising, well, you've got uncertainty on both, because the euro pound, for example, has come to the 0.80 boundary, which is a very strong boundary, and it's tried to break it, but it's failed. And the euro US dollar is coming to 115, trying to break it and failed. So again, these are all these are all signs that we're not really getting much from the currency side in terms of spot forex or direction. A final thought is we don't have a centralized counter for volume, but we have an indicator which is useful, at least because it doesn't rely on retail data. It relies on price itself, and it's an average, of course, of close, high, and low. But this is the ATR, average true range. So the average true range tells you basically, on average, the curve of volatility. This is on the daily chart for EURUSD. And you can see from that, I was talking about April of last year, and we're at the bottom of that 105. And there was a lot of volatility. We're going up to average almost 200 pips per day. And it's dropped all the way, and now we're down to these lows that we had in early December. So we're down to about 70-80 pips per day. Okay, so that's more than half, or rather less than half. And this kind of tells you that there is worth in doing this, because you can gauge roughly not so much retail sentiment. You can gauge the mood of the market. I posted a forum thread recently talking about something is very quiet in the markets and what is going on. So you can see, for example, from 2015, April of last year, and we're again, like the EURUSD, we're at a height here of about 200 pips per day. This is pound US dollar, and then we drop low and we stay low until about here, which was beginning of the year. From the beginning of the year with the pound US dollar, we actually picked up, and we're about 150 pips per day. So about halfway between this low and high in the last year. So the pound US dollar is actually more active than Euro US dollar. So if you were to trade, for example, pound positive, going back to the pound, a pound positive, sort of going long the pound on this historic low, there's more movement in the pound, and it could gain more ground to the upside. Euro USD being so quiet at the moment, we don't know what's happening directionally. You think going short off the 115 top might be better. Again, all these things tell you that there is uncertainty in the markets. Deciding which pair to trade is one of the problems, as well as which direction to trade it in, medium to long term. I hope that these resources have helped you and will help you. And certainly, I would try to keep an eye on one or two of them, not all of them at the same time, or you go crazy. But try and really keep one or two. If you're trading not many pairs, there will be correlations between the pairs, and then try to pick a theme. For example, if you're trading pound pairs or euro pairs, or between the two, keep an eye on euro futures, pound futures, and also on a daily basis, or also the COT weekly, to see where non-commercial speculators are actually positioning. And then you've got the sort of long term, and compare that with sort of levels, historic levels, and you can see also the correlation between Gilts and pound, or LIBOR and pound, or you can compare EURIBOR and euro. So you've got all these options. I'd like to thank you for listening, and I hope you found this useful. And please leave comments, as always. I'd appreciate that. Thank you very much.